take what I'm about to say with a grain of salt, because I can think of plenty of counter examples, and actually even for myself, I turned $10,000 into over $200,000 by doing the opposite what I'm about to tell you what to do. So I may seem like a hypocrite, but there's a reason for it, and really the reason is because if you are a new beginner or novice options trader, I don't even care if you've been trading for a year or two, if you have not done this yourself, it's hard to understand it, and it's about trying to play with implied volatility. So I've seen newbies do this, and I've seen people who are even teaching online about this, about how they try to hack with implied volatility, and that's their secret to make a bunch of money with options. So for example, let's take a covered call seller, where their goal of mine is to buy stocks that they like and then collect income for it, either monthly or weekly or even yearly. And I've seen people give advice like, oh, I sell covered calls when the implied volatility shoots up. Now, me being the math nerd, I realize that's actually an issue, because when implied volatility shoots up, probability also goes counter ways for option sellers. So practically, your probability of profit actually becomes way, way lower, or probability of the contract actually exercising, which I think that's where you're going to care about more if you're a seller, that the chance of getting assigned is way, way higher when implied volatility shoots up. Because practically all what implied volatility is a bet of how much that stock is going to shoot back up. So there's no free lunch with implied volatility. So if you're buying option contracts and you're like, you know what, I'm only going to buy option contracts when the implied volatility shoots down really, really low. The issue with that is when implied volatility is really, really low, the overall bet is that the stock's not going to move very much. And that doesn't change. Implied volatility is not constant, but when it's there, it's there. So that's the probability right then and there. And it doesn't, if the implied volatility shoots down 50%, there's nothing stopping it from going down another 50%, which then loses your gains. So now again, if you're very experienced and maybe you believe that there's some type of overreaction or underreaction, or if you feel like there's a certain time for this, then it makes sense. But take, for example, earnings. A lot of people know that implied volatility spikes up and option contracts are just more expensive during earnings. And a lot of people will say, stay away from earnings, which is generally valid. And especially if you're, let's say, doing covered calls and you don't want to get assigned, you're probably going to stay away from earnings. But there's actually no difference between implied volatility spiking and just the implied volatility spiking at any time. It's still the same probability. So, with that said, if you're an options trader, there's a few things you need to do. You need to stick to a strategy, and you need to stick, it depends what you're looking for, right? If you're an option buyer, then obviously stick to your play. Stick to that, keep making sure that you're not going all heavy into a few contracts or going all heavy into a couple stocks. If you're an option seller, I'll talk more about this. I feel like I can give a little more advice, for option sellers here. Don't try to always make implied volatility plays until you've made a lot of money, because the issue with this is you could have huge FOMO, so that's one thing, right? You can have huge FOMO that, okay, you're doing cover calls or you're doing all these things, you're doing the wheel strategy and the stock just shoots up, and then now, it no longer comes back down, because that's why there's implied volatility, is that they're expecting some big movement. And you know what? Okay, the earnings are coming up, or, they know that now there's some extra traction in the stock. Maybe, people did research and found out that Nike is really pumping up its, visitors to their e-commerce site. So maybe that's why implied volatility is going up. There's so many different factors, and the point is, you don't know what they are, where it can be a very dangerous move for you to try to predict that. And for option buyers, if you're new to this and you're trying to play in volatility, because again, the crazy thing is there's a lot of times where stocks, the implied volatility shoots up, where it goes up to 200%, but it doesn't mean it doesn't stop there. It can keep going up higher and higher and higher. And even if it doesn't go up higher, the stock can still move so high that it doesn't. Because you'll typically see, when stocks go down, implied volatility kind of goes up, or when stocks go up, implied volatility goes down. But again, either way, this really should not be a beginner's way of thinking, because the issue you have associated with this is that the only way to make money through options is through crazy movements and volatility. Look right now, think to yourself, how many people are posting YouTube videos? How many people are talking about options on social media? Way, way less than it was during COVID, because the volatility was so high, and that attracted a lot of people from making big moves. But now, why is no one talking about it? Because they can't make the big moves anymore, or even worse, they lost money. So again, remember that implied volatility shoots up, so does the probability. So if you're an options trader, that is worse for you. Depending when you're holding, or even when I mean, I guess, again, maybe it's better if you're buying options. That's why they're worth more. But again, you're still paying the price. So in no way associated with that is it free lunch. Like if you're an options buyer, implied volatility shoots up, and if you don't own the contract yet, like you're not getting better odds by buying it because you're just paying a higher price now. And for a seller, again, it's kind of a bit rough in that situation. So remember, probability, it affects the implied volatility, so you're not getting any free lunch.